Hello there. Welcome to the Open right here on BNN Bloomberg. Here are the big stories we're bringing you from our newsroom. Bank of Nova Scotia topped profit estimates in its latest quarter on better than expected results in the bank's capital markets and wealth management divisions. The financial services giant also booked a restructuring charge mainly related to workforce reductions. Scotiabank is 2 years into a strategic overhaul, with its international division tracking ahead of plans, while earnings growth at home has been slower. Laurentian Bank is selling itself to privately held lender Fairstone Bank for $1.9 billion. Fairstone offers a variety of financial products, including loans. Of course, it absorbed the former Home Capital. Before the transaction closes, however, National Bank of Canada will acquire all of Laurentian's retail and small business assets and liabilities. Laurentian put itself up for sale in 2023, but failed to find a buyer. Shares in document database company MongoDB jumping in the pre-market, up more than 23%. The company raised its full-year outlook as demand from AI continued to bolster revenue. The company says it is expanding its existing customer base and adding new customers on a net basis. MongoDB's database platform also expanded 30% from the previous year. And it looks like we are going to get a positive open on Wall Street this morning. Let's check out how the TSX traded yesterday. The market, of course, near record highs. It slipped slightly yesterday. Let's have a look at oil and see how it's faring this morning. Oil weak again, still stuck below $60. Let's check out gold, which of course has been boosted by the almost unanimous opinion on Wall Street that the Fed will cut interest rates again this month. And that is seen as good for bullion over the long term, or certainly in the short term, I should say. And there is gold losing a bit of altitude today, but you can see that sharp rally it's had over the past few weeks. And finally, the Canadian dollar. Let's see how our currency is doing this morning. And it's holding its own against the greenback. Lots of news in banking today, including the acquisition of Laurentian Bank by Fairstone and National Bank. We're joined by Lawrence Steinberg, president of Lawrence Steinberg Wealth Management. Great to see you.
Great to be here, Andy.
So finally, Laurentian Bank, it's been a long, painful story for investors. Maybe you can put up a 5-year chart, but it is coming off the public markets.
And finally, I mean, Laurentian has never been able to compete with the other Canadian banks, never been able to get their technology act together, don't have the capital. This is a great deal for shareholders, and even though there will be layoffs, the Caisse de dépôt in Quebec is in favor of the deal. It'll be better for their customers as well as National Bank takes over the loan book and deposit book, and it's turning a chapter. No more Laurentian Bank branches in the province of Quebec.
The shareholders in Laurentian Bank get something. They get $40.50.
Absolutely. I think it's at least a fair deal for shareholders, and they can redeploy their capital elsewhere. And the deal looks like it makes a lot of sense for everybody.
But it looks, from my reading of it, it looks like Laurentian's branch employees and branches will all be gone. National Bank's just shutting all that down.
Exactly. They're simply buying the deposits and the loans, National Bank. Fairstone's going to buy the commercial operations, and it's a sad day for the employees.
Yeah, there's some vague assurance that they'll be eligible for jobs at National Bank. Yeah. Talk to us about Bank of Nova Scotia. It looks like they are delivering under their relatively new CEO. He's been there about, I think, 2 years
Almost
now.
3 years.
Oh, 3 years.
Almost 3 years in February.
Not that new. Yeah.
And, he took over. They embarked on a strategic plan, de-emphasizing Latin America and redeploying capital, Andy, and really more domestically, U.S., wealth management, and the like, coming off a rather brutally bad 10-year period for the stock. And for shareholders, let me say the strategic plan seems to be working. It's well underway. Significant improvement in wealth management, certainly in capital markets area. And ongoing, and international as well to some degree, but the Canadian operations still have some work to do.
Yeah, I'm just looking at broadly provisions for credit losses, about 1.1 billion, slightly above what Raymond James was watching for. I guess provisions for credit losses are going to be a hot topic this reporting season.
They are, and so far we're not seeing, don't expect to see any huge increase in the PCLs, I have to say. Canadians are still in decent shape, and interestingly enough, in the last quarter, so far, bankruptcies and on the consumer side and business side have actually been a tick lower a bit. But if this economy continues to moderate, for sure that'll be an issue.
Which banks do you own, Lauren? Can you give us some
We
idea?
own the big five, actually.
Okay.
The only one we don't own is National Bank.
Oh.
We own them in different weightings. National Bank we are most bullish on only because the valuation is such a wide valuation gap between everybody else.
Sorry, Lauren, National Bank you're less bullish on? Or?
National Bank we're just less, but sorry, Bank of Nova Scotia we are most bullish on.
Oh, I see, sorry.
Because of the valuation gap, lower priced earnings ratio, lower price to book, but really this big improvement we expect Bank of Nova Scotia the next couple of years to outperform in terms of earnings per share growth the rest of the sector.
Maybe we could put up a 5-year chart for a Bank of Nova Scotia or even a 10-year chart, because I'm not clear actually whether they're back into record territory yet. Some of the banks, as you know, have been doing that. It looks as though they are near a record anyway.
Sure, but they've underperformed the rest of the sector in a significant way. Listen, I have to say it was a bit of a surprise. This new CEO came from outside of the banking sector. But maybe they needed a fresh pair of eyes to really focus this business, and I think they're doing a very fine job.
What is your feeling on the worry that AI is something of a circular bubble, that NVIDIA gets big contracts and then uses that money to invest in its customers?
Sure. So the positive side of AI, like AI is real. All of the Canadian banks are laying people off in large part because of AI. The issue is all of the so-called AI tech and communication companies, the NVIDIA, Alphabet, et cetera, they are plowing so much money into capital expenditures in the next couple of years, in the hundreds of billions of dollars. There's a question, will they get a return on all of that money? Or is this becoming a game where everybody's trying to outspend the other player? And one of the risks we see in the markets going forward, in 2026, if these companies' earnings deteriorate somewhat, there could be quite a long way to fall for some of those companies.
A couple of stocks on your radar here, Nestle and Unilever, global consumer products giants.
Sure, this is one of the many ignored sectors. And Nestle, if you're buying it, you're getting it close to a 10-year low. Again, new management, we're looking for earnings to rebound over the next few years, close to the double-digit level. Coffee's their biggest business. Pet food is their next biggest business. They distribute all Starbucks coffee, actually, that is not sold in a Starbucks. And so this is a company that is extremely cheap, biggest food company in the world, poised for some good earnings growth. Unilever, a little bit more advanced in their turnaround. They're experiencing better earnings growth. But again, both of these companies, massive global footprint, somewhat ignored by investors with everybody flowing money into tech.
And so offering decent prospects, those two.
Decent prospects, also good dividends, healthy dividend growth going forward, and best in the business.
Lauren, thank you very much.
Andy, it's great to be here.
Lauren Steinberg, president of Lauren Steinberg Wealth Management. Coming up, shares in Transat were up yesterday. The Quebec billionaire Pierre-Carl Péladeau wants changes on the board. We're going to hear more from Péladeau after this, and we'll check out his message to investors. That's ahead. Shares in Air Transat rose yesterday after news that Quebecor CEO Pierre-Carl Pelado has demanded a board shakeup and strategic overhaul at the travel company. We were joined by Pelado, and he shared his vision for the future of the airline.
We're talking about a company that have a market cap of $80 million. And I think that at this stage, regarding the balance sheet and the situation of the company, it will worth much more, to invest in the business, and instead of, investing at the board of directors and everything that goes with it. So then, therefore, given, and I've been there for many months, even many years now, reviewing what was the strategy of the company, and we're forced, to conclude that right now everything that had been taken by the board had been mostly a failure. So the balance sheet is broken. We need to fix the balance sheet, because they will not going to take any other investment will take place without making sure that, we're going to arrive at the first base. It's like a baseball game, If you want to go at the second or the third base, you need to go to the first. And the first base for this company is to fix the balance sheet.
Okay.
It's completely the opposite of the industry. It is the worst balance sheet that you've seen. And then, therefore, if you don't fix it, you run the risk, to get this business out of business one day or another.
Okay, so let's talk a little bit about support. There are 11 board members, I understand. You want to take it down to 6. You want to be on the board. Have you been talking to other shareholders or board members about this? What kind of support have you had?
Yeah, we've been talking with other shareholders. I think that, we're completely aligned. Every shareholder would like to see, this business moving forward successfully. There's 2 large shareholders. One is la Caisse de dépôt, and the other one is the Fonds de solidarité de la FTQ. We've been in discussion because, again, everyone believes this company have a very strong brand. They've been at the heart of Quebecers for so many years. This business is in the right position or in the right industry because it's a growing industry. We all know that life expectation brings people spending more, traveling more. But you need to have, the proper strategy and, again, the proper balance sheet to be able to succeed.
That being said, they have made some progress on paying down their debt. It was $800 million a year ago. Now it's under $400 million, or at least it was by end of summer. I believe that was the beginning or end of July, beginning of August. So they are making progress there. You think you can make that situation come about more quickly, cutting the debt more quickly?
The debt reduction comes from a write-off of the largest creditor, which is, the government of Canada, that had been helping, the company during the pandemic. Today, you're in front of quite of a situation of a kind, I would say, Here's a company that is major creditor is the government of Canada. Here's a company that the largest shareholder is the government of Canada. And here's, a company where the regulator is the government of Canada. So how can you really, believe in the future of the company if you sit on different seats like this, and one day, you'll be for the red, and the other day you'll be for the blue? That doesn't make sense.
Okay. So you want to cut, sorry to interrupt you, I'm running on limited time. You want to cut the board, which will cut costs, but how else would you reduce debt for this company?
Yeah, again, we need to restructure the balance sheet and then, therefore, sit with the major creditors and making sure that, we'll be able to find the proper balance of debt and also in terms of cash injections. Because today, any dollar that will be invested in the company will go directly, reducing the government of Canada debt. So you cannot ensure the viability of the company with that kind of conditions that you have right now. If you want to succeed, then you need to make sure that you will invest in the company, invest in the product, invest in the customer service. I use the example of Videotron that had been very, very successful since we took over in 2000. It is the company that had been able to invest in wireless. We grew significantly there. Customer service, we have the proper balance sheet. We've been investing in the proper places. And this is what we would like to do with Transat. So, again, illustrate it, with what we've been able to do.
Okay.
We're in front of the company where the board was incapable of moving the needle. It's been there. We're facing a failure, and then therefore we need some significant changes. And this is what we're proposing down the road.
Quebecor Inc. CEO and President Pierre-Karl Péladeau. Yesterday, Allied Properties REIT slashed the distribution. We'll talk to an analyst who still has a sell on the name. We'll be right back. Urban office space developer Allied Properties has cut its monthly distribution by 60% as the company tries to get its debt under control. We're joined now by Lorne Calmer, VP in Institutional Equity Research Real Estate at Desjardins. Lorne, thanks very much for joining us. Really appreciate it. For now, you still have a sell on Allied Properties. You think there's still more work to be done?
Absolutely. I think the distribution cut certainly was a big step in the right direction. I think it was a prudent move by management and the board. Arguably a little bit later than it should have been, but nevertheless, I guess better late than never. But as we sit here and look at the story, we look at the broader office landscape and some of the Allied specific challenges in the, coming down the pipe. We still think at this point there's a little bit more risk to the downside than there is upside to the name right now.
You're just reading your report. You say it's not 100% clear whether the distribution cut is permanent, but did you get any clarity on that?
I think I'm going to run under the assumption that they were setting a distribution policy for, obviously December 25 and 26. What I had thought about when I read the press release initially was something a la First Capital, where they temporarily cut the distribution during COVID and then reinstated it at the full level. I don't believe that's the case. I haven't received clarification as of right now, but for the time being, we're operating under the assumption that the distribution cut is a permanent distribution cut.
What was the problem at Allied? Just persistent weakness in their office real estate market?
That was definitely a large portion of it. I think what the catalyst for management and the board to finally approve a distribution cut was the slower than anticipated rebound in occupancy. And this was something that when we looked at the broader office market, we thought would be a challenge for the REIT, and really for all office properties outside of the core Class A plus. The way we sort of looked at the recovery in the office market is sort of a three-phase recovery. The first is being driven by RTO, the return to office, right? We've seen some of the banks come back. A couple other large users have announced they're coming back. But we expected the lion's share of that recovery to be concentrated in the cores, in the buildings that you typically see banks occupy, right? Those big glass skyscrapers connected to the path as it relates to Toronto. And we believe that a more fulsome recovery would require a rebound in Canada's economic outlook, in business sentiment, and office using employment. And we think we're still a ways out from that. And even as that does begin to recover, we think, there's still going to be a lot of Class A vacancy there. Like I think Class A vacancy in Toronto is still around 14 or 15%. So we need to see that get down to kind of, in our view at least, the high single digit level before we see demand cascade outside of the core, outside of these Class A properties, and into the type of assets that Allied owns.
Did they've been involved in some big real estate projects in Toronto. I'm thinking about the Well, that giant development there. Did they bite off more than they could chew?
Hindsight's always 20/20. I think if you knew COVID was coming, you'd probably say yes. But to their credit, they got that office property 98% leased. And they actually finished the leasing during COVID. What happened there was Shopify, which was their anchor tenant, I believe they had about 350,000 square feet of space, decided they were no longer going to have an office-centric model. And as a result, they put up that space for sublease. And it's been it's been a challenge for Allied to find a replacement tenant, but they have, I think they've spoken to the fact that they have had a lot of interest there, and we expect some more updates as it relates to that space. I believe they have made some decent progress there in the last little bit.
Maybe we'll put up the unit price again, ap.un. Is there a particular level at which you would be inclined to go to a buy? Right now, as you know, it's just above $13.
Mm-hmm. I think, as I mentioned, we think there's still a few headwinds that present some downside risk to the stock price. I think if we get more clarity there, I mean, the big one is fundamentals. There's a couple other capital allocation, potentially negative catalysts that could come their way that we're a little bit concerned about. But I think if we get more clarity there, I'd certainly become more constructive on the stock. And the other way I've sort of looked at it is if you look at the stock on a yield basis, a distribution yield basis, based on the revised distribution, at current levels, it's a sub 5.5% distribution yield. We think that's a little bit tight. Probably 6 to 7% is a little bit more appropriate as things stand today. And a 6% distribution yield implies about a $12 stock price. 7% is about $10.20. So we think, if we get down into that 10, 11% range, it certainly makes a lot more sense to start adding at that point. But for now, we think it still screens a little bit expensive. Mm-hmm. And the other way we also look at it is, as you probably know, on an implied cap rate basis. And, where it's trading right now, it's about a 6.8 cap. And just based on the transactions that we've seen in the market, and granted, they've been limited, but there have been some, we believe that still screens a little bit expensive based on the geography and the type of product that Allied owns.
We've less than 30 seconds. The office market, has it more or less stabilized? Can you generalize, Lauren?
I would say it's certainly come off its bottom. Mm-hmm. It is in the process of stabilizing. As I sort of alluded to before, we think the initial phase of this recovery, the RTO, has definitely taken hold. But until we see a broader recovery in Canada's economic outlook, office usage of employment, the things I spoke to earlier, we think that there's still going to be some challenges there for the broader Canadian office market.
Lauren, thank you very much indeed. Lauren Calmer of Desjardins. We've got lots more ahead, but up next, those opening bells. There are the opening bells of the Nasdaq. It's Pledge 1% doing the honors. At the NYSE, it's Paul Atkins, chairman of the U.S. Securities and Exchange Commission, ringing the bell. At the TSX, it's Hemlo Mining Corporation celebrating its new listing on the Venture Exchange. It's time for the first 15. And let's check in on the equity markets. We'll start off with the big bourses. And sure enough, they are higher this morning. The TSX in record territory, getting close to a record, even if it's not quite there. You can see the S&P 500 and the Nasdaq both higher in early trading. Some stocks of interest here. Let's have a look at Scotia reporting numbers that the street liked. Stock in record territory. It was a beat on earnings. Laurentian is finally going to be taken over. The company has tried to sell itself and failed over the years, and it's finally being bought by a private lender, the same company as owns the former Home Capital, at a 20% premium, and you can see that stock is jumping. And National Bank is picking up a lot of the retail business of Laurentian Bank, but not taking on the liabilities involved with the branch structure. And it looks like investors like the sound of that. Let's get some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Thanks very much for joining us, Jeff. Start off with Boeing. Some good news for investors?
Yeah, some good news for investors. A long time coming for Boeing investors. The stock is up 3.8% so far. It's definitely worth watching today. That's a pretty big move for the plane maker. Obviously, this is kind of one of those companies that has been kind of struggling since some of those issues that it has had to face with some safety, et cetera. It now expects to be free cash flow positive in 2026. It's still looking at $2 billion in free cash outflows this year, but next year it says is expected to be positive. And the CFO was speaking this morning, said the recovery is well underway in full force, is the quote, full force for recovery for Boeing shares. So it is moving higher this morning, definitely worth watching over the course of the trading session today.
The Trump family linked crypto entity American Bitcoin has seen some selling on this crypto downturn.
Yeah, a lot of selling, and it's definitely worth watching, partly just because of the people involved. Pardon me. So Eric Trump is a co-founder of this company as well as one of the executives. He's chief strategy officer. Donald Trump Jr. is also a shareholder in the company. American Bitcoin shares were down 20% this morning. They are down 60% from their peak in September, and that is coming as Bitcoin is down about 30% from its peak in October. So a really sharp move down for this company. Bitcoin has been kind of one of the signals within the market. Broader kind of risk sentiment has been falling as Bitcoin and other cryptocurrencies have been falling. And this is one that's definitely worth watching, partly because of the names involved and also just because of the size of the move.
And then lithium. Albemarle is a huge global player, and it's getting an upgrade from Baird.
That's right. It's getting an upgrade. Baird says that this is potentially, it's not an all-the-way upgrade to buy, but Baird is upgrading this stock to neutral from underperform, raising the price target fairly significantly to $113 a share from $81 a share. The analyst is saying here that even though electric vehicle demand is not as robust as perhaps hoped, there is still demand for lithium for energy storage applications, and that is what is providing a little bit of relief for this stock. Albemarle, which is the largest lithium producer in the world, is up 49% this year. That's a pretty decent sized bounce for this lithium company, which has seen a few tough years in a row. It was down 40% in 2024. It was down in 2023. It was down only single digits in 2022, but it's been a long time coming. It's now up 49%, and we'll watch to see what the move today does, whether it adds to that further.
Jeff, always great hearing from you. Thanks very much. That's Bloomberg's Jeff Morgan. Lots more market action coming up. We're going to hear more about the case for diversifying internationally. We'll be right back. Let's take a broader look at the market. Our guest says certain countries for a while may dominate, but nothing lasts forever. We're joined by Nate Tuft, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment Management. Great to see you.
Great to be back.
It seems like forever the U.S. has been the place to be, but investors should always remember history's a guide. No market stays on top permanently.
That's absolutely true. And this isn't to dismiss the fact that the United States has great quality companies that compound very well. But when you look overseas, there are other countries, and even this year you see that with some of the returns that we're seeing. Areas like Japan have done fairly well. Parts of the EM economies, particularly the Koreas of the world, the Taiwans of the world. What's the common theme with some of these? They are still related to that broader technology AI theme. And increasingly, as we've seen over the course of the last several years, there is a bifurcation of how you build technology now. You have people that are building technology from a Western perspective, and then you have the Eastern perspective, which is more aligned with the China side of things. And so the companies that are building AI in Asia are equally benefiting from the massive secular trend in AI, just as we're seeing in North America with some of the big tech companies in the United States.
Would you be inclined to own Chinese technology stocks, Alibaba or Baidu, just to name two?
Yeah, there are some great opportunities in China. And we think about China in a couple different ways. Parts of the economy are showing some real signs of health, particularly things that are related to infrastructure and manufacturing. The other part of the economy that's still a bit lagging is more the consumer-driven side of things, as well as the real estate market. So you kind of have this dynamic where half the economy is doing well and half of it isn't.
In China, sorry.
In China specifically. And so the part of the economy that we like and the names we like tend to lean more on the infrastructure and manufacturing side, which is inclusive of the AI spending and the build out of AI technology.
And Japan is on your radar here.
Japan is an interesting one for us because, one, it is an economy that has a lot of individual stocks within their stock market. There is some evidence of M&A activity, for one. Two, margins of companies in Japan have been on a consistent year-over-year trend of improvement. They will never get to the same level of profit margin in our view as, let's say, high-quality U.S. companies. But we do believe that there is continued evidence that we're going to see improving shareholder friendliness in Japan. At the same time, valuations are reasonable, and you have an economy that is trying to normalize monetary policy, which actually is a positive in our view when it comes to the opposite of what other central banks are doing. But at the same time, they do need to get their interest rates back to a more normalized level, and the health of that overall we think is a positive versus a negative that sometimes the market believes it is.
But wouldn't that increase the borrowing costs for Japanese companies?
It does, but at the same time, they have such a weird dynamic with their yield curve right now that it's really hard to function from a societal perspective when you have yields as low as they are. So some level of normalization is a positive, but you have to be very, very cautious about how they do it and when they do it, because the currency is a key link in our view. You don't want the currency to strengthen too much, but you also don't want it to weaken too much.
You make an interesting point here that we think of healthcare, defensive, but artificial intelligence could be a big boost for profitability and productivity in healthcare.
What we've seen with the AI plays so far is the AI winners have really been what we call the AI enablers, the people that are allowing AI infrastructure to be built. What hasn't benefited are what we would call the beneficiaries. And the beneficiaries include healthcare companies and software companies, as an example. They've actually been penalized because the fear has been that AI is somehow going to just take over and then someone else can do what they do. But that's probably not true, particularly with healthcare. So improvements in how quickly you can develop drugs, as an example, improvements how you can do human diagnostics and clinical tests, all are benefits that you can get from AI technology.
Yeah, I remember a former senior bureaucrat in healthcare telling me a lot of money is wasted because of poor patient management. For example, somebody will have a chronic illness, but they won't get it treated. They won't take their meds or whatever. And then they end up on the emerge, which costs a fortune.
Yes.
But presumably AI could help noticing patterns like that.
Noticing patterns, catching things much quicker, and lowering the number of negative or positive false type of data points that sometimes come out of more simple testing. And so that type of stuff can really improve the efficiency of healthcare and the data within healthcare.
And certainly doctors say they're distracted by all the bureaucracy, and AI is apparently being designed to help them with that.
Of course, efficiency and scale are two of the key themes coming out of AI.
What about bonds? What is your attitude to bonds these days? Are you overweight, for example, in government fixed income?
We're underweight, but we are very careful about how we talk about bond exposure. It is a necessary part of a client portfolio. When we think about bond exposure, we obviously do have to separate the dynamics of what duration impact is, interest rate movements, from credit quality.
Right.
Right now, the credit quality is very good, but it's fully priced in the market. Spreads are likely not going to get much tighter, so we're not going to get a lot of return from there. On the interest rate side, we do think central banks, including the United States, will continue to lower rates, but we do have worries further out of the yield curve. So what we're advocating for our clients is to remain underweight duration and remain underweight longer interest rate asset classes.
Sorry, because you're concerned about inflation?
Because we're concerned about inflation, but also because we're concerned about the value of term premium. The amount that you're willing to take from a risk perspective isn't high enough to own those long bonds. Okay. So we're advocating for bonds that are more intermediate in duration to shorter duration and higher quality in nature.
Okay, and finally, we touched on AI. Do you think there's a risk of a circular inflation of AI values, companies investing in each other, for example?
There is absolutely a risk. There is no doubt that not every AI player that is winning right now will continue to win. There will be disappointments, and there will be some missteps. But at the same time, the fear around the AI bubble almost makes me feel that we're not at the end because there's so much attention on it and there's so much focus on kind of holding back because of those concerns around valuations that I think the runway for AI and the secular theme is probably a lot longer than people think.
Nathan, thank you very much as ever.
Thank you.
Nathan Tuft has been our guest, Chief Investment Officer and Senior Portfolio Manager at Manulife Investment and Management. We have lots more ahead on the open. Yesterday on Market Call, we were joined by Michael Hakes, Senior Portfolio Manager at Murray Wealth Group. He covered US and global stocks. His top picks were United Health, Lululemon, and Neat.com. Today, it's Jordan Zinberg, President and CEO of Bedford Park Capital. The topic, Canadian small and mid-cap stocks. Up next, we're going to focus on those job cuts at Algoma Steel. The company struggling in the face of high tariffs. And remember, Diageo is also cutting employment in this country. That's ahead. U.S. tariffs have taken a toll on Canada's steel sector, specifically Ontario's Algoma Steel. That company has laid off almost half of its workforce. CTV's Abigail Beeman has the latest in this report.
1,000 layoff notices at Algoma Steel, more than a third of its 2,700 workers in Sault Ste. Marie.
It's very devastating when you live in a community that doesn't have a lot of job opportunities and you're finding out that your job is going to end.
In a statement, the company blamed American tariffs. As a result of these pressures, Algoma has been forced to conclude its long history as an integrated steel manufacturer and close its blast furnace and coke-making operations in early 2026. Algoma will transition to electric arc furnace steelmaking at that time, a year earlier than previously anticipated or planned.
Moving away from the older blast furnaces to new electric furnaces, really as an environmental thing, that's a good thing to happen. Now they're having to do that with a gun in their head because of the tariffs.
In September, the federal government gave Algoma a $400 million loan, the province $100 million.
Our thoughts are with them. Prime Minister looked them in the eye and promised he would protect their jobs.
My team and I have been in contact with Algoma's leadership team. We absolutely have every confidence in the Algoma workers as they're going through this hardship, and we will make sure that we support them.
The union says the government offered money without proper conditions to protect workers.
This city cannot provide employment for 900 additional job seekers.
To help those workers, the city's mayor wants to push other local projects like a deep sea port.
We're going to make sure that those files are in front of the Premier's office, in front of the Prime Minister's office.
Ontario says it's launching a local centre to help impacted workers, including retraining. The layoffs take effect in March of next year.
That's our CTV News colleague, Abigail Beeman. Interesting that Algoma is laying off those people after getting hundreds of millions of dollars in potential support. Meanwhile, the federal government, under Prime Minister Mark Carney, is trying to bolster Canada's economy. He and the Alberta Premier, Danielle Smith, jointly agreed to work towards a pipeline to the BC coast. But there are hurdles here. CTV's Mike LeCouture filed this report.
Do you support a pipeline? Opposition MPs grilled the Environment Minister about a possible new pipeline from Alberta to the BC coast. But Julie DeBruzen says it's not only up to the federal government.
And we're not going to override the jurisdiction of our provinces, and we're not going to override the rights of Indigenous rights holders.
While the federal government does have the jurisdiction over interprovincial pipelines, the minister says any project will have to involve all stakeholders. Coastal First Nations are opposed to a pipeline going through their land in northwestern BC, and the former head of Kinder Morgan Canada points out there is another path.
Is it Kitimat? Is it Prince Rupert? Is it Vancouver? Do we go back to Vancouver and build another pipe, along the existing Trans Mountain route, which is always an alternative?
Premier Danielle Smith repeatedly pointed to the port of Prince Rupert. Smith says it's easier than sending tankers through the 159 nautical mile long Douglas Channel to Kitimat, BC.
When I look at Port au Prince Rupert, a lot of those issues don't exist there because it is right on the ocean.
On CTV's question period, BC Premier David Eby said he'd be willing to talk about a pipeline through his province if the tanker ban remains in place. Still, the MP for the Prince Rupert area believes it's too early to talk about any route without talking to communities.
With First Nations, it's different because nothing really starts until an official consultation and accommodation process starts.
And that consultation has to start soon. The deadline for Alberta to submit its pipeline application to the Federal Major Projects Office is July 1st.
Coming up, Laurentian Bank selling itself to Fairstone Bank. Shareholders are getting a premium of about 20%. We're going to have more on that after the break. So Laurentian Bank, it's been something of an unhappy story for investors over the years with low returns, finally selling itself to a private outfit called Fairstone Bank in an all-cash deal. Let's get more on Bay Street reaction here. We're joined by BNN Bloomberg's Lindsay Biscaya. Lindsay.
Hi. Yeah, and it seems like it's mixed reaction at this point on Bloomberg. Two analysts have updated their ratings today. One is at a hold, the other is at an underperform when it comes to Laurentian Bank. But what's interesting is the focus doesn't really seem to be on Laurentian as much as it is on the National Bank of Canada. We spoke with Rob Wessel, co-founder of Hamilton ETFs this morning. He says this is a small deal. What he's really watching for is not reaction to Laurentian. We can see, of course, they're trending up at the moment. But what he's watching for is reaction to National Bank and how that stock performs today. Because as part of this deal, of course, as we've been talking about, Laurentian will sell its retail and small and medium-sized business banking portfolios to National Bank of Canada. You can see National Bank up more than 1% at the moment, 1.3%. So Wessel says this is a great deal for National. He says they don't have to close any branches. They don't have to lay off any staff. They're not taking on any of those troubles that Laurentian has been dealing with for quite some time. And he says National Bank has been, overperforming for quite some time as well. So they're in a really good spot. As for Laurentian, Wessel says this is a 20% premium to yesterday's close. It's as good as it's going to get for the bank. So he says this is a good deal for Laurentian. Here's more on what he had to say this morning.
On Laurentian, this is kind of, I don't want to see the end of an era, but we now have the two small banks are gone, Canadian Western Bank and Laurentian. And Laurentian has been struggling for a very long period of time, almost my entire career, 30-plus year career, Laurentian has struggled. They managed to sell off of a reasonable multiple. So I think Laurentian is not that big a deal. I think the market will probably focus much more on National Bank, which is obviously a very, very successful company. And I think at the margins, this is not a marginal transaction for National Bank. This is actually a pretty good one. They acquire retail loans and deposits. They get some SME loans. They get some small, medium enterprises, what SME stands for, and some deposits. It looks like it's going to be accretive to about 2%. It's going to be accretive to ROE. So, this is essentially a book value transaction. And so, it just incrementally strengthens National Bank in Quebec, which is obviously their ballast or their moat, if you will.
And so according to Bloomberg Intelligence, this is expected to add about 1.5 to 2% to earnings per share for National Bank of Canada. It also adds $4 billion of loans, $8 billion of deposits. And many analysts are saying there is reason to be cautious only because the trade war that we're seeing might limit profits. But otherwise, it seems to be pretty positive all around.
That's interesting. Just circling back, Jeffrey's saying National Bank is getting a neat deal here because they're not taking on any messiness associated with the bank, with the branches, etc.
Exactly. Yeah. John Aiken at Jefferies sent a report this morning saying that this is going to benefit shareholders in a way that they actually weren't really expecting when it comes to this exit. And yeah, he says National Bank, acquired Canadian Western Bank, of course, and that kind of further consolidated that Canadian banking landscape as well. So it kind of seemed like it was in the cards for Laurentian to do something similar. But as you mentioned, yeah, they're not taking on any of that kind of baggage that Laurentian has been carrying for some time. So a lot of people saying that this is really going to be benefiting Canadian National Bank the most.
And National Bank actually hitting a record high today.
Oh, okay.
Stock, yeah.
Yeah.
Lindsay, thank you very much indeed. Lindsay Biscaya of BNN Bloomberg. Let's check out some stocks of interest in Toronto. We're going to start off with Go Easy. We kind of neglect, there's so much going on in financial services. We kind of neglected this story. There's a change at the top. at Go Easy. Dan Rees is stepping down as CEO for health reasons. Jefferies does have a buy on the stock. We're leaning on John Aiken of Jefferies a lot today. Says there's been ongoing turmoil in the executive ranks, and there was a short sellers report casting something of a shadow over the shares already. Jeffrey says this management loss could present additional delays in returning Go Easy to its previous levels of profitability. So the stock down a little bit today. Let's have a look at Shopify, because they had a big Black Friday and Cyber Monday. The stock did see some selling yesterday. There were reports of outages around the world, but the shares are rising today, up more than 34% in the past year. Let's have a look at Celestica. It tends to trade on sentiment over AI. The shares down from the record high, but rallying today because, of course, they're a huge supplier, not just of equipment, but entire assemblies for AI computing. Coming up, we are going to update you on the latest headlines, and we'll drill into that Scotia earnings beat. Thanks very much for tuning into The Open. Welcome to the second hour of The Open here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. Shares in Laurentian Bank rising today after the lender said it is selling itself in two parts. Privately held Fairstone Bank will buy Laurentian for $1.9 billion, or $4.50 a share in cash. Separately, however, National Bank of Canada will acquire all of Laurentian's retail and small business assets. Laurentian will pull out of retail banking to focus on commercial real estate. Eric Provost remains as CEO. Shares in Scotiabank edging higher. The lender topped profit and revenue estimates in its latest quarter. Net income surged 31%. The results were driven by better than expected performance in the capital markets and wealth management divisions. Scotia is 2 years into a strategic overhaul, with its international division tracking ahead of plans. Vale Base Metals has signed an agreement with Glencore Canada to jointly evaluate a potential copper development project at their adjacent properties near Sudbury, Ontario. If it all works out, Vale and Glencore intend to transition to a joint venture as equal partners in the project. The agreement involves working out of existing infrastructure at Glencore's mine in the area. And here is a look at our market. The TSX slipping slightly. It opened higher, but we are still slightly down from Friday's record high close for the Canadian benchmark. And let's have a look at how the U.S. market is doing. Right now, you can see the S&P pushing higher. It is still down, though, from its record high close of 6,890 on October 28th. And let's have another look at oil here. Oil still stuck below $60. One bullish factor here is possible attacks or more disruption at Russia's oil facilities in the Black Sea. Of course, that could ultimately curb supply. Let's have a look at gold, see how it's faring. We did see gold losing a bit of altitude earlier, and you can see slipping. Silver has been the story, though. Silver has been setting record after record this year. And finally, let's have a look at the loonie, the Canadian dollar, as we anticipate an interest rate cut on December 10th by the U.S. Federal Reserve, but the Bank of Canada not seen as making its own reduction. Scotia beating earnings estimates in its latest quarter. However, our guest feels this is a somewhat lower quality beat because it wasn't driven by strength in the regular banking division. Let's get more from Rebecca Telcher, Portfolio Manager at New Haven Asset Management. Rebecca, great to see you, and thanks very much indeed for joining us. So that's what you essentially look for with reports like this, the regular banking to outperform?
I mean, obviously we look at it as a whole, but, I guess when I'm looking at the banks, I want to see overall health in the economy and sustainable growth. And that's more something you would look at for loan growth, provision for credit losses, I think, and that's more what investors are looking for. Obviously, today's earnings were pretty good. But if I'm looking at the two largest beats, like the segments that had the largest beats, it was wealth management and capital markets. So like wealth management was up 17% year over year, capital markets up 50% year over year. And what we've seen historically is those segments can be very inconsistent, and they're also very much based on what the market is doing. Mm-hmm. I've been saying for a while, it's like a self-fulfilling prophecy, right? So, the stock market's doing really well this year. And so obviously more investors are getting invested in the market. That's going to drive AUM up. That's going to drive, transactions up on the capital market side. So it's not surprising those two segments are the best performing segments in a market like this.
The Canadian bank stocks near record highs. They got there on Friday. They're not far off that now. Valuations in the sector giving you something of a pause?
Yeah, it's interesting. I always say you could be a really good company, but not necessarily a good stock at that time. And that's how I feel about the banks right now. So, am I worried about the banks, financial health? Absolutely not. Like, do I think the banks are going to, survive and prosper in the next 20 years? Sure. They're well capitalized. They're well managed. So I am positive about the banks as a company. Where I have a little bit of concern right now is more on the valuation side. So, the average bank, like the banks as a whole, are trading at about over 13 times earnings. Historically, banks traded around 11 times earnings, or a little bit over 11. But it's interesting how it's trading at such a premium in the face of a weakening Canadian economy. I mean, to me, I feel as if Canada is already in a recession or inching its way towards it. So, it's odd to see, banks performing so well when we're seeing signs of economic weakness. I mean, the banks on average are up 30% year to date. Scotia in particular is up 25% year to date, a little bit more, right now after today's earnings. So a little bit of cause for concern with regards to adding new money to the sector now. That being said, we are invested in the banks for our existing clients. We're just hesitant to add additional money at these valuations.
And Scotia trading slightly below in terms of price earnings. Sorry, just go over that again. And the highest yield of the group?
Yeah, so Scotia, I mean, is on a valuation basis is cheaper than average. So we talked about the average being over 13 times. Scotia's a little bit less than 12. So I feel a little bit more confident. However, Scotia is still trading above its long-term average with itself, about 10.5. So again, because Scotia's just had, issues with regards to its international business and some management changes. So I think it has a little bit more to go with regards to getting back on track for consistent growth. But, it is also trading at the highest dividend yield of the bunch at 4.5% yield. It's interesting, the banks have always been these consistent dividend, strong dividend yields. But now with, the stock prices inching up so high, Royal Bank is now having a less than 3% dividend yield. So for yield investors like us, it's surprising to see such low yields in the bank when we're used to seeing more like higher yields.
Laurentian Bank finally finding a buyer and a premium, but if we look at a 5-year stock, still investors aren't getting the share price that it traded at a few years ago.
I think this is I think, Laurentian Bank shareholders should be thanking their lucky stars that they were able to to get a deal. I think, 2 years ago, they announced that they were looking, for like they had a strategic plan. That didn't go through. They couldn't find a buyer. Stock dropped from, $43 to $25 in a matter of 2 months. But now, the deal at $40 is pretty close to what what it was originally trading at 2 years ago. And, since then, we've seen, Canadian banks don't really have so much of an appetite. I think the one bank that had the appetite, National Bank, then they went out and purchased CWB. And so, all hope for them purchasing, Laurentian at that time, went out the window. But now we're seeing this transaction kind of like a little bit of a hybrid where they're taking on some of the assets, but not much of the risk in terms of the branches or employees. And then they found a private buyer, which is a best case scenario, I think, right now for Laurentian Bank. I don't think anyone else is willing to buy it or pay, what they would pay, what they were looking for 2 years ago.
Rebecca, for the rest of the year, what do you think you'll be doing? I actually saw a funny thing on Instagram today, a lady saying that at this time of the year, she adopts a policy of let's deal with it in the new year. Let's circle back next year. But you're busy. I know it's a busy time for portfolio managers. What will you be doing for the rest of December?
Praying for no more dividend cuts. I mean, we've seen a few this year, some that we own, some that we don't own. It's and just, staying the course. I mean, markets continue to be, in our opinion, overvalued, reasonably valued in some sectors, but overvalued in a lot of other sectors. And that's causing concern for us. So we are not rushing to deploy new capital. Our clients that are invested remain invested so they can compound those dividends. But for new money coming in and for those dividend flows that are coming in, we are, holding that in cash on the side, waiting for a better opportunity.
Rebecca, thank you very much indeed. And I hope we get to talk to you again in 2025. You're always one of our favorites. Rebecca Telcher.
Well, I'm on market call on Thursday, so you don't have to wait too long.
We can never get enough of you. Rebecca Telcher.
Thank you so much.
Portfolio manager at New Haven Asset Management. Coming up, we are going to look at the commercial real estate sector and check out some potential opportunities. That's when we come back. Let's take a global look at real estate in the commercial sector, with a focus on Europe. Our guest says we are in the early stages of a steady recovery in real estate. Let's get more from Kieran Farrelly, Chief Investment Officer in Real Estate at Schroders Capital. Kieran, thanks very much indeed for joining us.
Morning, Andy. Great to be here.
Start off with office, would you? And I know we're painting with a broad brush here, but it was pretty traumatic for the office sector, COVID. A lot of people still working at home. Has there been globally a recovery in office valuations?
So look, there's been a very significant adjustment in prices and values. So you're talking 40 to 50% plus when we look across the major developed markets globally. We're certainly seeing, return to work becoming much more normalized. It's really hastened in Asia Pacific, where there are those dense urban environments. So that just brings people to that office space a little quicker. I think what we're really seeing, Andy, is some of that commodity office, some of that oversupply, and really referencing the US in particular there, really starting to flush through the system. So if you want, that highly amenitized, sustainable, real future-proof space, there's actually something of a shortage of that. And high construction costs, high interest costs are curtailing new supply going forward. So it's definitely going in the right direction.
So that's interesting. So for people with existing office properties, that's good news. What are big premier prestige companies doing, though? Are they still renting the same amount of space in general?
I think on the margins, some of it is reducing. They're still growing. space is still being crowded. I think what you're seeing is a very clear statement of preference. Again, coming back to that amenity provision, ensuring their staff have more communal, collaborative space than perhaps before, and sustainability considerations really taking a lot of precedence.
Can we switch now to what the industry calls logistics? A lot of that being, of course, warehouses. What's going on there? We saw a boom, obviously, during COVID. People were shopping from home. Has that boom continued?
It has, Andy. Look, there's been a bit of oversupply, which is being digested at the moment. But e-commerce penetration rates are lagging, particularly in parts of Europe, for example. So we see some of that oversupply getting taken up fairly quickly. And I think there's something of an obsolescence cycle playing through. So there's going to be shortages of some of that really sustainable, again, future-proof space coming through in the next few years. And we see a very strong demand curve.
Now, we're focusing on commercial real estate here, but can you give us any trends that are occurring in residential globally?
Generally shortages, particularly of mid-market and affordable space. I think we clearly have aging demographics playing through. So again, lots of opportunity to create the space for aging citizens all the way through to sort of care provision and associated healthcare type real estate. So general shortages, the demographics are supportive, urbanization trends are abound. Again, we are short of housing in many markets globally.
It's interesting. And what is the problem here? I know the Economist magazine likes to talk about NIMBYism, especially in Britain. But what is the roadblock to building more housing?
Construction costs. They've really stepped up, particularly through that pandemic period. And again, if we look forward, if there are large-scale rebuilding programs needed in parts of the world, then that will put even more pressure on materials supply chains, for example. You've got a lot of factors at play. So things like increasing household formation, a lot of us living together in smaller household sizes, and again, that densification requirement. So again, the debt finance costs, the general sort of more moderate outlook for the economy. It's all coming together, and we're just not building enough. And again, governments are addressing that in various ways globally. We've seen, for example, in London, where there's affordable housing requirements as part of large-scale developments, and some of that's being relaxed to allow them to become more viable.
That's interesting. They're just allowing them to include fewer affordable units.
Yeah, at the margin. And look, anything that can be done to help support that, the much-needed new building programs, there is that support coming through.
And then just finally, what's the trend in hospitality now? We know there's been a backlash over the past few years against Airbnb, for example, not just in Barcelona, but in cities around the world. Are many new hotels being built?
They are. Look, there's a global trend, let's call it experiential. Like, people want that experience, they want to travel. It's actually a real structural trend that the hospitality sector has been growing against. Around Airbnb and the like. Yeah, look, in different guises in different countries, and cities in particular, there are responses to that. So, but look, serviced accommodation, new hotels are absolutely being built. And particularly now we're seeing more business travel coming through, in that post-pandemic, sort of as part of that post-pandemic recovery. We certainly saw a really quick recovery as people wanted to get out, having been, in various locations, being obviously constrained from travel and the like. So markets like Japan, for example, there's been a, really strong rebound, and that's something we were taking advantage of there. Again, serviced accommodation, as well as sort of broader, more typical hotels and the like.
Thank you very much indeed, Kieran.
Pleasure. Thank you.
Kieran Farrelly, Chief Investment Officer in Real Estate at Schroders Capital. Coming up, we're going to hear about this record year for ETFs in Canada and a shift among investors in interest from the TSX 60 to the broader TSX Composite. We'll be right back. ETFs have revolutionized investment over the past decade or more. We're delighted to be able to bring you these regular ETF reports. And let's get one of our favorite guests on, Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets. It's great to see you.
Thanks for having me, Andy.
Just focus on Canada for a sec, if you would. It has been a big year of inflows into ETFs.
Yes, really big record year, 2025. We hit the kind of inflow record even ahead of the U.S., but both markets are on pace for 20% growth in additional capital flowing into the ETF structure.
And even in November, which saw some choppy trading weakness in the tech stocks, for example, there were still people buying equity ETFs.
Yes, another month, another record. This year in the U.S., it was the highest daily average inflows into ETFs all year, $7.3 billion a day going into ETFs. And this is over double the 2024 run rate. So just incredible growth. And yes, November was a choppy month, but ETF investors were there and deploying capital.
And despite these worries we hear expressed about a handful of tech stocks dominating the S&P 500, that giant Vanguard S&P ETF just bringing in money.
It is like a vacuum cleaner, just kind of cleaning up assets. And really, this is just showing, I think, the retail interest. And you know what? These investors were almost treating any day of market weakness like a Black Friday sale and seeing this as an opportunity to put additional funds to work. So we're seeing cash, I think, coming from the sidelines and moving into S&P 500 exposure, especially if there is any daily weakness or sustained weakness.
So we got this giant VOO, the Vanguard S&P 500 ETF, and you say it's taken in about $125 billion US year to date.
Absolutely stunning. No other ETF in the world has taken in so much capital, and it's nearly 10% of all US ETF flows. So 1 in every $10 invested in an ETF this year has gone into VOO. It's just incredible.
VOO, is that what you call it?
Yeah, that's what we call the ticker.
Okay, thanks. We always love to get a bit of jargon here.
Yes.
The leveraged ETFs have been another hot commodity this year. They come in different forms. Sometimes it's leverage, or sometimes they use engineering to increase the yield.
Correct. So there's this, what we call like a light leverage, which is a little bit of a quarter turn just to enhance returns. But then there are these kind of major leverage products. So it's 2x, 3x. You're really trying to amplify the return, amplify kind of the investment you're making. And we saw incredible inflows into leveraged ETFs in November, $6 billion, the second highest monthly inflows into levered ETFs. And really, again, this is investors trying to bottom pick the market, seeing different pockets of weakness and think they can take on the additional risk because it's going to turn into additional returns.
And can you just remind us, I know we can't get into the weeds too much here, but these leveraged single stock ETFs, are they designed to be held over an extended period, or are they one of these deals where you just capture the daily move in the stock?
Yes, absolutely not. Do not hold these products over an extended period of time. There is this mechanism called NAV erosion, which it happens in all this kind of structuring. They are primarily meant as kind of daily or weekly trading vehicles. You have a directional bet, you make that bet, but these should not be buy and hold products.
I wonder, are a lot of investors buying these things thinking, well, it's leverage NVIDIA, I'll just hold it and hold it. And that's often a bad idea.
That is a bad idea. The way these are designed are meant to be trading vehicles and kind of short-term in nature.
We have seen outflows from Bitcoin ETFs with the decline in crypto prices, but you're saying it hasn't been a wholesale flight?
No, actually, and I think it's really proven kind of the investors that are using the ETF vehicle to allocate to cryptocurrency. So it's been a very violent move in the price. You know, I think 30% from October highs lower. So 30% is a massive move. But we have not seen outflows. We have not seen investors running to the exits. There have been kind of modest outflows, I think $3 billion, but that is less than 5% of all AUM. And I think it's just proof of concept that investors are using the ETF to make a portfolio allocation, using it as a real allocation tool rather than a trading vehicle.
Now, we don't have the same prominent tech stocks obviously dominating our index in the same way as the US, but people have a choice here. They can buy the traditional XIU, which tracks the TSX 60, which generally follows the composite pretty closely. But are you seeing more interest in investors wanting the other stocks?
Yes, we've seen the composite, which is a broader index, 250 Canadian equities versus just the largest 60. And we've seen consistent outperformance. And this outperformance has been the trend over the last few months, but we saw it even further exacerbated in November as well. This has really been driven by the materials sector. There's a larger weighting in the composite, and that has been a key driving force of this outperformance. And so to the tune of 30 basis points in November, you had outperformance in the composite versus the large caps, Canadian large caps.
And I think this is for November. There were nearly $4 billion of inflows into Canadian equity ETFs.
Absolutely incredible. And the $4 billion is 4x the kind of monthly run rate. And so this has really been driven by institutional demand. So really the institutions kind of backing this narrative and putting my assets to work through the ETF and buying Canadian equity exposure right now. So it's really been a proof of concept and really seeing those big flows follow the performance.
Valerie, thank you very much indeed.
Great, thank you.
Valerie Grimba, Director of Global ETF Strategy at RBC Capital Markets. Up next, we're going to tell you more about Vale and Glencore exploring a possible joint project in Sudbury, Ontario. We'll be right back. Laurentian Bank shares moving higher today, up around 18%. The lender is selling itself to privately held Fairstone Bank in a deal valued at almost $2 billion. Fairstone is a group of privately held Canadian lending companies. It offers a variety of financial products. National Bank of Canada, meanwhile, will acquire Laurentian's retail and small business assets and liabilities. Laurentian put itself up for sale in 2023, but failed to find a buyer. Shares in MongoDB surging today, up 25%. That's after the database software company raised its full-year profit and revenue outlook as demand for AI services continues to bolster revenue. The company's database platform expanded 30% year over year, and Mongo says its customer base is expanding. Shares in GoEasy seeing some pressure. The CEO, Dan Rees, is stepping down at the consumer lender, citing health problems. GoEasy says the move is due to a blood disorder that requires Rees to resign from his position. Patrick Enns, who is currently president of Easy Financial, will become CEO on January 1st. Rees will serve as special advisor to the CEO through June 30th. And there is a quick look at the markets. The TSX slipping a little in trading this morning. U.S. markets are up. Let me just have a quick look at the stocks helping to lift or supporting Toronto right now. Manulife is down in early trading, but Bank of Nova Scotia is up more than $1. In fact, a lot of the banks are doing well. Bank of Montreal has jumped more than $2, and Royal Bank of Canada is also higher. Shopify is up more than $8. And let's check in on oil as the market braces for what could be a big surplus next year. And investors, the world priced the Brent contract trading near $73. Investors are waiting U.S. President Donald Trump's next steps on Venezuela. There's been speculation he might approve some kind of attack. American forces apparently have been massing near that country, and the White House has been increasing the rhetoric against the government of Nicolas Maduro. And let's have a look at gold. At a time when military action is being talked of, you might expect gold to do well, but it's slipping down around 1%. And finally, let's have a quick look at the Canadian dollar, our currency holding its own, up about 0.1% against the greenback. Vale Base Metals has agreed with Glencore Canada to evaluate a potential copper development project at their adjacent properties near Sudbury, Ontario. Let's get more from Bloomberg's senior metals reporter, James Atwood. James, thanks very much for joining us. What do we know so far, please?
Well, these two companies, Vale and Glencore, have been in talks on and off for the best part of 2 decades, and finally they're putting forward a proposal. They haven't greenlit it yet in terms of investment, but they've agreed to study a brownfield project, a joint venture, which would be leveraging the two properties, neighbouring properties in Sudbury, as you say. And the idea is they'd be spending as much as $2 billion to connect these adjacent operations and tap into copper deposit. Not a huge project in terms of production, but fairly significant that they're looking to move forward right now with copper prices at record highs.
Yeah, and it's interesting too. I mean, as you know, Vale is considering a possible IPO of its base metal operations. I bet Glencore will be interested, possibly in acquiring some of Vale's base operations.
Possibly. I mean, of course, these kind of deals trigger speculation on what might happen next. To be fair, Vale's been talking about an IPO for a while, and there's nothing concrete just yet in terms of the base metals operations. The company, of course, based in Brazil, it's a global major mining company, is having an investor day in London right now, and the CEO did make reference to the idea that while the priority is on developing their own assets, they are in some kind of discussions regarding opportunities to sort of fast track the copper expansion. We don't know what exactly those opportunities are, but and interesting that they are looking at opportunities beyond their own project pipeline.
And maybe we could have a quick look at the copper price. As you say, near record highs. It was distorted by fear of US President Donald Trump's tariffs. That created a huge rush to move copper into America. Then it tanked, but it has been rallying since, near record highs.
That's right. We've got a sort of second stage of that story with traders and others in the market looking at the possibility of tariffs next year, as soon as next year. And so we're looking at more copper being sent to the US, and that's squeezing supplies elsewhere in the world, which is helping to push up that price. There are other factors, of course, including disappointments on the supply side with various mines suffering setbacks.
Mm-hmm. James, thank you very much. Great to hear from you. James Atwood, Bloomberg senior metals reporter. After this, we're going to check out some hot picks in the auto sector. We're going to hear the case for buying Ferrari. We'll be right back. On Hot Picks today, we are checking out the auto sector. Our guest has Ferrari as his top pick. He expects that company's first all-electric vehicle will bring in new buyers in key markets such as California, the Nordic countries, and China. We're joined by Tom Narayan, lead global autos equity analyst at RBC Capital Markets. Tom, great to see you as ever. Thanks for joining us. Start off with Ferrari. Remind us why you think things are looking up for this car company.
Yeah, I mean, it's very difficult usually to get people really interested in buying the stock because it's usually always so expensive. But they have an interesting opportunity, investors do, because the stock has pulled back 20% after its October investor day. And there's some people worried about its EV. We are not. They have this really interesting car, the F80. There are 800 of them they're going to sell. They're $4 million cars. When you do the math on that, it's incredible, super profitable. So the setup is really great, given this 20% pullback in the stock. Finally, investors who want to buy this stock, I think it's a great time for them to participate, and they get to benefit from this F80 car, which starts deliveries in Q4 of this year.
What's that car? Sorry, Tom.
Yeah, it's basically.
Go ahead.
It's basically a supercar that's they're going to make 800 of those in its lifetime. They're going to sell them over just 3-year period, and they cost $4 million a car. So the profits on those are incredible, right? Unless you're putting $1 million of costs or something, which is, I mean, car is a car at the end of the day. So super profitable. Huge boost to numbers in 2025 and in 2026, and then really 2027. I think some folks who got a little spooked at the October 9th Investor Day. I think there's a lot of new people in the stock who kind of pulled out, and now I think the core holders, the people who want to own Ferrari, are kind of waiting on the sidelines a little bit. But now I do think folks will start buying the stock.
General, let's get a little more mundane here. General Motors, you see upside here, Tom. Why is that?
Yeah, I mean, this one has been a great performer. It's hard to also pitch this one now, given how strong it's performed, but I still think there's more upside here. Tariffs has been a great story, the resolution of them. They really benefit GM. USMCA is going to be negotiated, I think, June or July in 2026. It's a big catalyst for them. Also, you know, they do have some tariffs that come from their Korean imports. So we'll see probably some resolution there. And then outside of that, this is just as steady as she goes, 65, 70% of the large SUV market, and probably the best auto market in the world, the United States. They don't have to worry about China coming in the U.S. because of tariffs and because Americans aren't really buying EVs. It's a great relative play, and it has been working. So yeah, if it ain't broke, you know, let's keep going.
And what about pushback in America to the high sticker prices on cars? And that presumably that'll curb sales growth. People are just tired of these massive prices.
Yeah, no, you're right. But that's been the case for a while now. Yeah. Since the pandemic, we've seen a huge bout of inflation in car prices. But at the same time, you know, unemployment is really low. The economy is actually pretty healthy in the States, except for maybe the kind of lower end. People if you need a car, you have to buy a car. That's it. How do you else get to work? It's, you know, it's not a discretionary purchase really. And, you know, we calculate like a 6 to 7 million vehicle deficit, cars that were never purchased since the pandemic. Partly it's because of the high prices, but also it's just, you know, people weren't buying cars and they still need it. The cars are getting old and they have to replace the car to get to work. So, yeah, so we still think there's going to be some support, even despite the high pricing.
Tom, finally, Aptiv. Remind us what they do and why do you see upside? Sure.
Yeah, this is a really interesting auto supplier. They do some of the assisted driving technology, you know, cameras and some of the software there. And then they also do some hardware stuff, right? So they do wire harnesses and some of the electrical components. Why we like this stock, partly it's what we just talked about. There's a lot of strong demand in autos in the U.S., particularly their kind of core market. But also there's something cool that's happening. They're spinning out that wire harness business, and we think potentially it could get acquired. So, you know, if you're buying this stock now, you get to benefit from a takeout price of that asset or even the spin out. And then, you know, it's kind of the sum of the parts. You get to value all these different piece parts and also benefit from tariff recovery, relief next year, as well as the secular driver, which is this assisted driving ADAS functionalities.
Yeah, it's fascinating. Assisted driving and automatic driving, Tom, are we going to see incredible progress in the next few years, do you think?
Yeah, I mean, people have been waiting on this forever, including myself. It's been kind of slow going, right? Like People either want the car to drive them completely or not at all, right? So it has been difficult to kind of get consumers on board, but we are seeing this in China. I was just actually there last week, and people love that product, assisted driving. And of course, these guys, Aptiv sells these products in Europe, China, and the US. And we do think ultimately American buyers will want these products. And, eventually we'll get to a point, maybe it's level 3, where your eyes are off the road and your hands are kind of not on the steering wheel, but you're sitting in the driver's seat. That could be the kind of evolutionary phase that we go to next. And a company like Aptiv is definitely a beneficiary there.
Tom, thank you very much indeed for joining us. Tom Narayan, lead global autos equity analyst at RBC Capital Markets. Let's stick with the auto sector. New Brunswickers won't be seeing cheaper costs at the gas pumps anytime soon. That's despite promise by the New Brunswick Premier. CTV's Sarah Plowman filed this report.
Prices at the pumps didn't drop today, despite a promise by the Premier.
It's easy to promise, it's harder to deliver. I don't know what choice we have, really, right?
New Brunswick passed legislation to scrap a carbon surcharge on fuel prices. An extra 8 cents a liter passed on by refineries and retailers to cover the cost of federal environmental regulations. But 3 days before gas was to go down, the province's energy regulator canceled the cuts and sided with retailers and wholesalers by bringing in a temporary charge equal to what Premier Holt removed. The result? Fuel prices stay the same for now.
Yes, I'm quite frustrated by it because it's clear that New Brunswickers have been overcharged. We wanted to take that pressure off of them. It's been clear that the formula doesn't accurately cover costs that haven't been proven.
The provincial opposition claims the Premier misled the public.
I think she's got to come clean. She's got to tell New Brunswickers that she overpromised last fall.
Industry has argued New Brunswick's plan would threaten a quarter of the gas stations in the province.
We would have expected to see service stations not being able to survive without that margin.
The manager of this gas station says businesses like this one could not have absorbed the cost.
The big companies might be able to handle it, but the smaller ones, no way.
Premier Holt says she's looking at what the options are between now and February, when a final decision by the board is expected.
We're getting word on the latest Vancouver home sales, the MLS home price benchmark price for all properties in Metro Vancouver, down almost 4% year over year and slipping 0.3% from October. The current median price right now, or benchmark price, about 1.12 million. So down about 4% year over year, and home sales dropping sharply for November, down 15.4% from a year ago. So something of a cloud over the Vancouver real estate market right now. Okay, so we are getting more numbers on how Black Friday went, and we're also hearing how much Canadians are planning to spend for the holidays. More on that next. After hunting for the best Black Friday and Cyber Monday deals, how much are Canadians willing to spend this holiday season? CTV's Adrian Gabriel has more in this report.
December has arrived, and with it, a flurry of Canadian consumers.
Buying on sale matters a lot. The sales haven't been that good either.
We'll favor Canadian, even if it means a little higher price.
A survey by the Bank of Montreal has found that 3 in 5 Canadians are adjusting their holiday spending amid tariff concerns, with 37% focusing on made-in-Canada gifts.
Being a bit patriotic about, how they want to spend their money over the holiday season to sort of give back into the Canadian economy.
The economic headwinds from inflation to debt levels are causing some to keep a tighter grip on their wallets.
What consumers are saying, the top of the list is to save money this holiday season. And so if you're going to be marketing online for Cyber Monday, I suspect you're going to be bringing out your best deals.
And cost-conscious Canadians are shifting purchase priorities. This survey by the Business Development Bank of Canada says the average household is spending just over $940 this year. More than half of that is expected to go towards Canadian products, contributing to $11 billion to Canada's GDP while supporting thousands of jobs.
Canadians are really being mindful of how they're going to spend their money over the holidays and where they want to put their money. And I think for a large chunk, it still is going to be around supporting, Canadian businesses.
All Canadian.
All Canadian, all the time, everything.
Financial experts say taking the time to map out your shopping list as well as planning your purchases in advance are key to keeping a cap on your budget, trying to avoid those impulse buys and any last-minute shopping. The calendar has turned to December, and for those celebrating, the clock is ticking to get your gifts. Adrian Gobriel, CTV News, Toronto.
Let's check out the markets before we go. We did see a bit of a wobble for the TSX today. However, it is near record highs. And one stock of interest here, Group Dynamite. RBC just hiked its target price on this stock, and it's near record highs. It got to my screen is showing it got to a slightly higher level. Now it's in record territory, 76.49. So Group Dynamite hasn't been public very long, Quebec-based clothing retailer, and we are expecting earnings from that company before the market opens a week from now. That's on December 9th. Let's have a look at the TSX. See as it managed to blip into positive territory here. Still slightly down, but it has been a great year for Toronto stocks, excluding dividends. Our benchmark index up 25% this year. The S&P 500 is ahead only 16%. A couple of banking stocks to talk about here. Bank of Nova Scotia hitting a record high in trading today. The profit in the latest quarter beating expectations. And National Bank of Canada picking up a whole bunch of retail banking business from Laurentian Bank, which is selling itself in a two-part deal. National Bank of Canada shares hitting a record high as well. Laurentian Bank jumping because there is a premium of about 20% in this acquisition. Here's a stock that's hot, Equinox Gold. This stock hitting its highest in at least a year. I'm not clear whether that's a record high for Equinox. Just give me 1 second. But all gold miners, of course, posting massive cash flow right now with gold prices near record highs themselves. And if you have a silver in your portfolio, that's even tastier. So not a record high for Equinox. I'm showing that it was higher way back in 2011. Shopify, when that goes up, it tends to support the Canadian market. And sure enough, Shopify is up. They were hit with outages, though, on Cyber Monday. And finally, Celestica. Let's see how Celestica is doing. That stock has been a rocket ship over the past year, up well over threefold. Down a little today, maybe some investors taking profits after those massive gains. Thank you very much indeed for watching The Open. Morning Markets is coming your way next.